All right, let's just get straight to the damage. No pleasantries needed for a day like today. The scoreboard for Tuesday, January 20th, well, it's painting a very specific and, frankly, an ugly picture.
Yeah, pretty ugly is one way to put it.
The S&P 500, it closed down 1.2%. The Nasdaq composite slumped even harder, down 1.5%. And the Dow Jones Industrial Average shed about 1.1%, which translates to...
Roughly 536 points, just wiped clean off the board in one session.
And if you were trying to find any green on the screen, I mean, energy was the only real outlier, up 1.4%, but that was just tracking oil. Technology, though,
Total laggard.
the engine of this whole rally, down over 2%.
It was a brutal session. You know, if I had to put a label on the price action, I'd call it a choppy mess.
Yeah.
But more importantly, if you zoom out just a little, this really marks a definitive risk-off pivot. We came into the morning with sentiment gauges pretty neutral, drifting
Right.
by the closing bell. That neutrality is dead. This is now officially a show-me tape. The market is demanding proof before it buys a single thing.
So let's dig into the why. Because we didn't just sort of drift lower, we gapped down hard right at the open. It felt like the floor just fell out at 9:30 a.m.
You did.
And the sources we're looking at are all pointing to something huge on the geopolitical front as the catalyst.
It's a Greenland-sized headache, to put it mildly. And you have to understand, the driver here wasn't economic data. This wasn't CPI. It wasn't a whisper from the Fed, not a jobs report miss.
No.
It was the White House threatening 10% tariffs on 8 NATO allies. That was the headline that hit the wires this morning.
Which is, I mean, that's just an absolute nightmare for the algos.
Oh, it's kryptonite. Total kryptonite. When you threaten trade wars with strategic allies, the algorithms, they don't wait for clarification. They don't wait for the press secretary to walk it back.
They just sell.
They sell. And that sharp gap down at the open, that was the market instantly pricing in a sudden structural trade threat. It's a variable that standard risk models just can't quantify, so the immediate reaction is to cut exposure everywhere.
And this is where the story gets really complicated, and I think where a lot of retail traders got hurt today. If you were watching the charts around lunchtime, you might have been fooled. I was looking at the price action right at 11:30 a.m. Eastern. The S&P, it made a really serious attempt to reclaim that 6,850 level.
It did.
On the chart, it looked like a recovery. It looked like that buy the dip muscle memory was finally kicking in.
And that is exactly what makes a session like today so dangerous. That 11:30 a.m. move.
Yeah.
Classic head fake.
It was a trap.
A trap for who? Retail?
Mostly retail, yeah, and maybe some of the slower momentum funds programmed to buy pullbacks. But when you look at the institutional flow data, the real plumbing of the market institutions were not buying that rally to hold it.
They were selling into it.
They were selling into the strength. They used that little bit of liquidity, that surge of optimism, to exit their positions. It wasn't a recovery. It was a door opening it just wide enough for the big money to leave the room, which explains why we couldn't hold those levels. We popped, and then we just rolled over hard. And looking under the hood, there's this really fascinating divergence. The cap-weighted indices were bleeding out.
Oh, yeah.
But the equal weight index, it showed a bit more resilience, at least at first. It suggests the pain was concentrated.
Well, ultimately, the Magnificent Seven just caught a cold.
Yeah.
And that is the structural shift we have to pay attention to. Usually you expect big tech to be the fortress, right? Today, they were the source of the weakness. But to really get the psychology of this market, to understand why this wasn't just another tech sell-off, you have to look at 3M, ticker MMM.
I was looking at that report. That one was a genuine head-scratcher for a lot of people. They reported earnings, they beat on the top and bottom lines, and the stock tanks 7%.
That divergence is the signal. In a normal bull market, an earnings beat gets rewarded. You get a gap up, you get analyst upgrades. Today, the market completely ignored it.
Just ignored the past performance.
Completely. They looked at the tariff headlines, they looked at 3M's global supply chain, and they punished the future margin risks. That tells you the market is obsessed with the what if of this trade war, not the what was of last quarter.
It's ruthless. It's basically saying, great quarter, but we don't believe you can do it again.
Exactly. It's a discounting mechanism. The market is discounting a future where margins get crushed by tariffs.
And it wasn't just 3M. We saw this bearish sentiment show up technically in the mega cap tech names too.
Yeah.
Nvidia, Amazon, Meta, they all posted what the chartists call outside down reversals.
Yeah, that's a big red flag.
For listeners who aren't glued to charts, can you break down what an outside down day actually signifies?
Sure. Think of it as a complete engulfing of the previous day's optimism. An outside down day is when a stock opens higher than the day before or near it, and then closes lower than the previous day's low.
So it just swallows the whole prior day.
It swallows it whole. It's a total rejection of value at those higher prices. And Nvidia is a perfect example today. It gapped down. It tried to fill that gap by noon. There's that head fake again. But then it just reversed hard to close at session lows, down 3.6%.
And when your market leaders are closing at the absolute lows of the day,
that is not a sign of absorption. That is distribution, plain and simple.
Okay, I want to unpack the internals a bit more because price is just the ad, right? Volume is the truth.
Always.
I'm looking at the data here. Volume spiked 22% above the 30-day moving average. Now, usually after a holiday, you expect things to be a little sluggish, a holiday hangover.
And that's the critical check. If we saw this drop on low volume, we could maybe dismiss it. We could say, oh, the big players are still out. This is just noise.
Right.
But this was not a low liquidity holiday hangover. A 22% volume spike on a down day is high conviction selling. It means everyone showed up to work today and their first order of business was to hit the sell button.
And they kept hitting it. The market on close imbalance, the orders queued up for the final bell was staggering. I'm seeing $2.8 billion to the sell side.
$2.8 billion. That is a massive number. I mean, for context, anything over $1 billion usually catches our eye. Nearly $3 billion means the smart money pensions, mutual funds, institutions. They spent the final 30 minutes of the session just hitting bids.
They wanted out. No interest in holding risk overnight.
Zero. And the breadth confirms the volume.
Yeah.
The NYSE advanced decline ratio cratered to what, 1 to 5?
1 to 5.
Right. So for every one stock that went up, 5 went down. That's not sector rotation. That's not taking profits in tech to buy industrials. That is broad-based liquidation.
So if they're selling equities with this much conviction, where's the money going? And looking at safe havens, it seems clear, but there's a weird twist with the currency today.
It's a textbook flight to quality with a major caveat. Gold hit an all-time high of $4,755.
Wow.
We saw massive bullish engulfing sessions in both gold and silver. So investors are parking capital in hard assets. But the interesting part is this is happening while the U.S. dollar is actually weakening a bit.
Which is unusual, isn't it? Usually, in a panic, the dollar spikes.
Typically, yeah. But you have to remember the catalyst, because the catalyst is a trade tariffs coming from the U.S. There's a fear of retaliation, a fear that a trade war hurts the U.S. economy specifically and the dollar's purchasing power. So gold is the primary hedge here, not the greenback.
And then there's the VIX, the fear index. It's moving, but it's not exploding.
The VIX is acting very specifically. It bounced hard off that 13.50 floor, closed near 14.80. So it's not a panic spike to 25 yet. But implied volley isn't collapsing because the unknowns are just too high.
Right.
But here's the real warning sign I'm watching. The 10-year Treasury yield is at 4.29%.
That seems to be the pressure point.
It is the absolute line in the sand. If that yield keeps climbing while gold is also climbing, the equity risk premium, basically the extra return you get for holding risky stocks over safe bonds, it gets way too thin.
The math just doesn't work anymore.
It doesn't. Why hold Nvidia at 40 times earnings with all this geopolitical risk when you can get a risk-free yield plus gold exposure? That's the calculation happening on desks right now.
And the math is starting to look bad for stocks. So, okay, we have a market pricing in risk, heavy institutional selling, a flight to gold. Sounds like that neutral sentiment is dead and buried.
Completely. The tape is lying to you if you think this is just a little pullback. The plumbing is leaking.
Okay, so let's pivot. Let's look ahead. We've analyzed the damage. But the goal here is to figure out what happens when the bell rings on Wednesday. What's the setup? There's a lot of chatter about this gamma wall.
This is the most important technical level on the board. If you have a sticky note, write this number down.
6,925 on the SPX.
6,925. Why that specific number? It's not just a support line from a chart, is it? No, it's about market mechanics. Think of 6,925 as a flip zone. Above that level, we're in positive gamma territory.
Okay.
In plain English, that means market makers, the dealers, act as a buffer. If the market drops, they buy. If it rallies, they sell. They suppress volatility.
Those stabilizers are on.
Exactly. Calm waters. But below 6,925, that's negative gamma. And that is a volatility accelerant.
Yeah.
In this zone, when the market drops, dealers are forced by their models to sell into the weakness. It makes the drops faster and harder.
And we closed below that level today.
We did.
Yeah.
We are in the danger zone, the accelerant zone. But, and this is where it gets fascinating for traders, this creates a high conviction trade opportunity for Wednesday.
I see it here in the notes, the gamma squeeze mean reversion. Talk me through this because gamma squeeze usually makes me think of stocks going to the moon, not mean reversion.
Well, it can be both. So because we're in this negative gamma zone, dealers are short gamma. They're hedged for a drop. But if we can get a spark, a catalyst, that pushes the SPX back above 6,135, those dealers are trapped.
Trapped how?
Their hedges are suddenly wrong. They're short, but the market's moving up. They have to buy back the market to protect themselves. This buying pressure forces prices up, which forces more buying.
A mechanical slingshot.
Exactly. It forces a liquidity event. If you get a 15-minute candle close above 6,935, it triggers a squeeze that could launch us toward that 7,000 psychological magnet. The risk-reward on that trade is about 1 to 4. It's an asymmetric bet on market mechanics.
So the trigger is 6,935. If we clear it, we could fly. If we stay below.
Then the trapdoor stays open. If we can't reclaim that level, the selling pressure from the dealers, that negative gamma, will likely push us down towards 6,800.
It's binary.
Very. You don't predict it, you react to the level.
Okay, so aside from the index, are there specific names to watch? Even in a sea of red, there are usually setups. I'm looking at Nvidia again. We said it closed poorly, but the chart is showing something at the 50-day moving average.
Yeah, this is what we call a day 2 play. Despite the ugly close, if you look at the intraday chart, NVDA printed a bullish pin bar right at its 50-day moving average, around $178.
A pin bar, let's just clarify. That's the candle with the long tail sticking down, right?
Correct. The price dipped way down, hit that level, and buyers stepped in aggressively and pushed it back up. That long tail signifies demand. Even though it closed down, buyers are there.
So how do you trade that? Just buy at the open?
No, absolutely not. Never buy blindly in this market. The trade here is all about confirmation. You need to see Nvidia break Tuesday's high, which is $182.40.
Oh, okay.
That break confirms the reversal. It proves the buyers at the 50-day are in control. Then your target would be a run back up to $195.
So wait for the trigger. Wait for the break of $182.40.
Discipline is the only way to survive a negative gamma tape.
Got it. One more name that stood out because it actually finished green on a red day. The Trade Desk, TTD.
A relative strength leader. While the rest of tech was getting hammered, TTD held up. And you have to look at the narrative. Ad spend is shifting away from the walled gardens like Google and Meta because of all the regulatory headwinds.
TTD is the beneficiary of that.
Right. It's the alternative. The setup here is simple. It has to hold $110 in the first 30 minutes of trading. If it holds that level while the market chops around, that's a go signal for a run to $118. It's showing you it wants to go higher.
I love that phrasing. It wants to go higher. You can almost feel that tension in some stocks.
You can, but you have to respect the gravity of the macro. If the whole market collapses, even the best stocks eventually get dragged down.
Speaking of gravity, we have a huge event tonight that could change the whole calculus for tomorrow morning, Netflix earnings.
The hook. All eyes are on Netflix.
It's become the bellwether for the consumer.
It has. And the big question is, will their subscriber numbers have enough alpha, enough surprise power to break the gravity of this tariff cycle?
If they miss, it could drag the whole tech sector down. It confirms the bear case.
Exactly. A miss validates the consumer is weakening narrative. It's just fuel for the fire. But if they beat, if they show strong growth, that could be the spark for that gamma squeeze we talked about.
It's the wild card. In a market like this, earnings are either a savior or an executioner.
And usually, there's no middle ground.
So let's wrap this up with a final directive for everyone listening. We've got the levels, we've got the narrative. What's the one thing they need to keep in mind to survive Wednesday?
The tape is lying. The indices might look stable for moments, but remember that $2.8 billion sell imbalance. The plumbing is leaking. The probability of a straight trend down day is actually lower now, about 42%, but the chance of chop and violent mean reversion is very high.
So don't chase the gap down.
Do not chase the gap down. If we open low, don't sell into the hole. Stick to the levels. Watch 6,925 on the SPX. If we're below it, be extremely careful. Cash is a position. If we reclaim it, look for that squeeze.
Stick to the levels. That's the mantra. We'll be watching that gamma wall and seeing if the bulls can pull off a rescue or if the bears are just getting started.
See you at the bell.